Good morning, traders. The global financial market faces a double whammy today. The FOMC meeting conclusion and high-stakes quarterly earnings reports. Risk appetite remains elevated, with yesterday's rally seeing the Dow Jones up 0.34% and Nasdaq Composite up 0.32%. S&P 500 E-mini futures are marginally higher by 0.15% pre-market, nearing the 6,900 level. Asian markets tracked U.S. tech optimism, with Japan's Nikkei surging 1.98%. and China's Shanghai Composite up 0.28%. The market narrative balances central bank optimism and tech dominance against geopolitical uncertainty and structural employment weakness. Today's price action hinges on the Fed's communication and earnings from three Magnificent Seven companies after the closing bell. The Fed's two-day policy meeting concludes today with consensus on a 25 basis point rate reduction to 3.75% to 4.0%. This easing is largely priced in, driven by lower inflation and softening labor market conditions. However, the rate cut is secondary to the Fed's commentary on quantitative tightening, the reduction of its balance sheet. Fixed income traders speculate the Fed may signal an end or reduction in the pace of quantitative tightening. This move is anticipated to alleviate liquidity stress and boost investor confidence in risk assets. The ongoing U.S. government shutdown has impaired policymaker visibility, delaying critical economic reports like the monthly jobs report. Consequently, the FOMC relies on non-official indicators, complicating policy rationale communication. The Conference Board Consumer Confidence Index inched down to 94.6, with the Expectations Index at 71.5, signaling an upcoming recession. Private labor data from ADP suggested cooling job growth, with only 14,250 jobs added in the 4 weeks to October 11th. This evidence of softening conditions justifies the Fed's anticipated easing even without complete government data. The IMF projects global growth to slow from 3.3% in 2024 to 3.2% in 2025, despite a modest near-term revision. Today marks a clash between monetary policy and corporate performance, with Microsoft, Alphabet, and Meta reporting earnings after market close. Microsoft is expected to report Q1 EPS of $3.66 on $74.96 billion in revenue, an 11% year-over-year growth. Analysts will focus on cloud computing margins. Alphabet's cloud business is under scrutiny, with expectations for improved capacity and commentary on AI infrastructure investment. For Meta Platforms, attention will be on justifying AI and metaverse spending, focusing on ad spending trends, and return on capital expenditures. The technological investment narrative was reinforced by a significant partnership between NVIDIA and Palantir Technologies. Palantir will integrate NVIDIA's accelerated computing and Nematron models into its ontology framework, powering the Palantir AI platform. This alliance targets complex corporate functions like logistics, allowing AI agents to rapidly generate and compare solutions. While AI drives efficiency, the broader economy grapples with job displacement. Global corporations like Amazon, Nestle, and UPS have ramped up job cuts, citing weak consumer sentiment and a push toward automation. American companies announced over 25,000 job cuts this month, with European job losses exceeding 20,000, heavily weighted by Nestle's 16,000 roles. This wave of layoffs disproportionately targets white-collar roles susceptible to AI automation. Executives are under pressure to demonstrate that large-scale AI capital investments generate immediate cost savings and margin improvements. The Fed's anticipated easing alongside AI-driven white-collar layoffs suggests a profound structural change in the labor market. This erosion of white-collar employment, coupled with low consumer confidence, risks derailing broader consumer spending. Today's limited economic calendar includes key releases providing context for the afternoon's Fed statement. Verizon reports Q3 2025 earnings at 8:30 a.m. ET, offering insight into telecom subscription health and consumer spending. Industrial bellwether Caterpillar also reports, offering insight into global industrial demand and infrastructure stability. The U.S. dollar has been softening recently, aligning with global trends favoring currency diversification. Crude oil is slightly lower at $60.08 USD. Gold remains largely unchanged at $3,981.90 USD. Gold is increasingly seen as a critical diversification tool due to political volatility, rising deficits, and evolving trade policies. Natural gas, however, has suffered a sharp decline, dropping 2.69% to $3.26 USD. A potential near-term tailwind. The U.S. may roll back some tariffs if Beijing cooperates on fentanyl chemical exports. Wayfair, the online home goods retailer, surged approximately 23.22% to $106.52. The rally was driven by robust Q3 results, demonstrating a shift toward operational efficiency, with 8.1% revenue growth and a 6.7% adjusted EBITDA margin. The sharpest decline was observed in Commvault Systems, whose stock plummeted between 16.29% and 19.62%. This sell-off was linked to its Q2 FY 2026 earnings report, which missed consensus on both non-GAAP EPS and total revenue. Despite marginal misses, the market's negative reaction is notable as the company achieved $1 billion in annualized recurring revenue ahead of target. This high volatility suggests capital is extremely sensitive to near-term profitability forecasts, crucial for traders approaching big tech earnings today. Research for this daily market pulse was conducted by Expert Trader UK utilizing data from Bloomberg, Reuters, Yahoo News, the Conference Board, and Morningstar. Crucial risk warning today represents a confluence of maximum systemic risk and stock-specific volatility. The collision of the FOMC decision and Magnificent Seven earnings creates conditions for sharp market reversals. Capital preservation measures should be prioritized until post-market results are digested and policy clarity emerges. If you found this market analysis valuable, please like this report and subscribe to the Expert Trader UK Daily Market Pulse.